One of the perks of quantitative trading done right is that the scientific process required to produce reliable systems will also provide you, retrospectively, with a more holistic understanding of those components that went into designing your systems. Among those major takeaways is without a doubt the symbiotic interaction between entries and exits. One cannot be effectively implemented in a vacuum without making sense with the other. Entries and exits talk to each other, and as the quality of your trading systems improves, you will quickly realize that trying to shoot for the supposed optimal entries or exits without any comprehension of the algorithmic context within which they are included is just as big a retail trading community hype as it is mathematically pointless. So in this video, we're going to straighten up your understanding of trade timing, unravel how to correctly determine entries and exits, and make sense of it all within a quantitative framework. Let's get it. Just like any technical endeavor that involves a process, long-term success in trading is not derived from an artistic effort of sorts. Rather, it is engineered using quantifiable inputs. And trade entries and exits do not get an exemption card just because they are the most easily illustrated concepts using pseudoscientific chart patterns and 4-year-old drawings on YouTube. So let's be abundantly clear about it. Setting proper entries and exits, just like trading in general, is not an art. It is a hard science. Aside from leading you straight to ruin, believing the contrary will inevitably lead you to get stuck in that tunnel vision that obsesses over finding the one-size-fits-all optimal entry technique or that perfect exit scheme that will guarantee your path to riches. And after all, how could you tell that this is the wrong way to go about it? If you've been made to believe that trading is an art and no proof of anything is required, then anything goes, right? At least that's the narrative that social media will want to feed you. The reality is that the answer is both more nuanced and harder to come by. Entries and exits are the endpoints of any trading strategy. By dictating your trade timing, they are the extremities of your system that actually interact with the market, where rubber meets the road, so to speak. Everything else is background work. So while your system's logic engineers the mathematical expectancy itself, entries and exits merely translate it into profit. There is nothing magical about their role in a trading strategy. They are nothing but a slave component of your system design that is derived from that all-important expectancy, which itself should be your only solitary point of focus as a quant. Absolutely everything else should be regarded as secondary. Likewise, it does not matter how accurate or fancy your entries. If your exit logic does not talk to them in a way that expresses a positive expectancy, then your system is as good as trash. As we will see it further down this course, this cohesive combination between entries and exits should not only primarily make sense with the price motion dynamics of the asset traded by your strategy, but it should also make sense from the standpoint of your overall portfolio. In any case, you need to snap out of that sniper mentality that is so often touted everywhere online. And that's for 3 reasons. First, you will never be able to reproduce that picture-perfect setup shown to you in these tutorials with enough regularity to become profitable. Why? Because it is based on anecdotal evidence, and anecdotal evidence does not yield expectancy. It yields brutal reality checks and margin calls. Second, because you do not need to be that accurate to become profitable. Positive expectancy can be perfectly generated by catching the thick of a move and leaving the extremities to those bottom-feeding traders that are in this business for an ego rush and self-validation. And third, keeping that sniper mentality is the mindset that will make you focus on the tree and forget about the forest. The tree being the trade, and the forest being the aggregated outcome of your overall strategy over thousands of trades. The aggregated outcome should be the only thing that matters to you. In fact, as a quant trader, the outcome of the next trade should not even be remembered after being recorded. As I just said, determining proper entries and exits should be understood at the mathematical stage from the standpoint of your market behavior first, then as pertains to your trading system design second, and finally within the context of your entire systematic portfolio. So let's start with your market behavior. This part will most likely come up as news to most newcomers to the quant trading arena. This is because a lot of mathematical background work will be required from you to understand first how the prices of the asset that you intend to trade actually move. So why so crucial? That's because without understanding it, you will not be able to establish an entry and exit logic that can properly capture your market movements. Specifically, let me describe 2 very peculiar characteristics that will underpin the success or failure of your assumptions regarding your trade timing. The first characteristic is the degree of conditionality affecting price movements, which you could also think of as the memory effect embedded in your price motion dynamics. Your goal here should be to determine to what extent your future price movement is affected by your latest price movement. This is obviously better quantified using continuous equations, but discrete quantifications using conditional probabilities would work just as well in most cases. So for example, bullish mean reversion observed in equities betrays a very strong memory effect, whereby today's drop preconditions tomorrow's rebound with a very strong correlation. Clearly, if we assume A to be today's drop and B to be tomorrow's rebound, then probability of B would be expected to be less than probability of B given A in most situations. Not only this, but you most likely can infer a quasi-linear relation between both, whereby the magnitude of the former dictates the intensity of the latter to some degree. As you can tell, knowing this market characteristic of conditionality has some very real implications in setting your entry defaults, even before any parametric input is applied. The second market characteristic is a derivative of conditionality. In fact, it is implied by it that conditional memory effect will also greatly influence the probabilistic structure that distributes how price moves from your entry point. So managing to model the probabilistic density of your market will mostly affect how you incorporate exits into your trade timing. Being able to discern whether your market is mostly subject to drift or momentum should allow you to make clearer and more astute choices as to whether you should shoot for cutting your losses short and letting your profits run, or letting your losses run and cutting your profits short. Evidently, these core market characteristics will also affect your acceptable win ratio, for as long as your expectancy remains positive, of course. For example, let's assume that you figure out that the only viable way to make money after cost off of a given market is during rare streaks of violent stretches of market volatility. Then you might be better off digging for an expectancy bearing a very low win rate, in the vicinity of 30 or so %, with rapid entries and exits. Dealing with US equities, on the contrary, due to the very characteristics of this market, the opposite is often true, and it is not uncommon to find profitable strategies working consistently with win ratios ranging from 55 to 65%, with slow entries and slow exits. As I said, knowing your market is half the job in getting you to apply entries and exits that make sense with what you're trying to trade. Only then comes the more general design of your strategy. But let's turn it up a notch now and move to the implementation of your algorithmic design and logic. I wish it were not the case, but mathematically knowing how your entries and exits should generally jive together, unfortunately, will not make you immune to failure either. System design is intricate, and the widespread trading culture will likely throw some major wrenches in your work, so let's get rid of them once and for all. There are a number of classic pitfalls that you should avoid. The most common one is to concentrate on the reward-to-risk ratio per trade as a dogmatic measure of expected profitability. So you will see traders obsess over making their reward-to-risk ratio necessarily positive, as if it provided any edge whatsoever by itself. This obviously betrays a dire misconception about what expectancy truly is. In practice, this erroneous bias would translate into shooting for gains that are a multiple of the maximum loss per trade. It may take the form of targeting 2 Rs or 3 Rs, for example, where traders will shoot to make 2 or 3 times as much what they stand to lose, as if probabilities were not going to adjust accordingly. If it only were that simple. The correct answer is evidently that you should focus on expectancy alone. Your reward-to-risk ratio is irrelevant by itself. In fact, some markets will even generally require you to have a negative reward-to-risk ratio by design in order to become profitable. Now, another classic trap in algorithmic design is to fall for the magic of partial closes. The main motive behind partial take-profit orders is mostly driven by the appeal of more psychological comfort. The intuitive idea here is that spreading the exit levels of a given trade should also spread the risk of reversal and therefore increase profitability while lowering risk. The problem with that line of thinking is that those who implement this strategy get confused by a group vision that views layering exits as a single strategy, when it should actually be split into as many strategies as there are exits, and each one should be assessed for what it's worth individually. For instance, let's say that your strategy expects to enter at level A and exit at rising levels B, C, and D, with half of the position being exited at B, 1/4 at C, and the last quarter at D. The expectancy of this strategy should really be broken down into 3 strategies and calculated individually for each one: the A to B, the A to C, and the A to D strategies. And as it turns out, you will very often figure out that one or more of them is actually not profitable at all by itself and should be objectively discarded entirely. For that reason, you must avoid that group vision when thinking about incorporating partial closes, even if the exit strategy seems to provide some psychological comfort since it appears to be spreading the risk of reversal. Likewise, along that same vein, The third pitfall is quite similar in the flawed logic that it relies on. I'm talking about profit locking schemes. If you don't see what I mean just yet, I'm sure you've heard of it in different words. Profit locking schemes will typically consist in moving your stop order to break even after being so many percent or pips in profit, or having a continuously trading stop running behind an open position. Once again, the motive is psychological comfort, but it is almost never properly quantified. And because trading exits are extremely vulnerable to noise in price movements, their impact on expectancy will often turn out to be catastrophic in certain markets. You may get away with it in high momentum markets, but they will more likely than not obliterate you in most others. As always, ignorance of the price motion dynamics of your underlying asset is the killer. And before you consider any of these options, you must both identify and quantify the drift to noise ratio of your asset's price movements. As you can see, a lot of nuance and mathematical discretion are required at the design stage of your algorithm, and you should never blindly apply these ready-made, cookie-cutter entry and exit schemes that you heard about on social media without carefully investigating quantitatively whether they make any sense at all from the standpoint of your expectancy. And lastly, let's tackle how to adjust your entries and exits within the broader context of your portfolio. And let's start with the concept of horizontal decorrelation that was extensively explained in this video. This goes counterintuitively, but as you broaden your portfolio of systems, you will find that on the same day, you might have conflicting signals to both buy and sell the same ticker, or contracts, or currency pair. And while it may seem absurd, it is in fact an excellent thing, because it means that your portfolio of systems is actually decorrelated, meaning that not all of your systems are leaning towards the same direction at the same time. Now, how does conflicting orders even make sense mathematically? The answer is timing. When two systems trade the same instrument in the same direction at the same time, they may exit them at a different time. Likewise, when they trade them at the same time but in opposite direction, they may exit them at different times as well, which may result in profit for both. As you can see in this illustration, two opposite trades can still make sense as long as entries and exits talk to each other in a way that yields positive expectancy for each system individually. And combining these seemingly contradicting systems within a given portfolio is a very substantial way that decorrelation is achieved. From a trade execution standpoint, it might require some adjustments in your workflow too. For example, if System A asks you to buy 100 shares of XYZ at the close and System B asks you to sell 120 shares at the close as well, you will have to net your trades and simply short 20 shares at the close. Now, another way entries and exits are balanced to complement a portfolio is through the implementation of vertical decorrelation, a concept yet again described in the video that I just mentioned. By building variations of the same system using parametric dialing, staggered entries and exits will become the byproduct of your efforts to decorrelate. So variations of the same system will yield slightly unsynchronized entries and exits, whether that is in terms of time or price levels, all of which will in turn enhance the overall decorrelation and the risk-adjusted performance of your portfolio. So if you're running a large portfolio, then get ready to manage a wide array of trades every day and make sure to keep track of them all in your own records, because it can become very easy to get confused by the volume and similarities of these entry and exit pairs. And finally, as you decorrelate your systematic set, whether your entries and exits are sufficiently diversified should be apparent in your portfolio's equity curve, whether it is expected through a backtest or realized in your brokerage historical records. What I mean is that enough decorrelation should make your portfolio agnostic to any of the two typical equity curves that blatantly show over-reliance on a certain type of price motion dynamics and how it is exploited. Let me be clearer here and illustrate those equity curves by showing you both extremes. The first extreme is the martingale type of equity curve. It is characterized by constant rises punctuated by sharp and often terminal drops. An equity curve like this one will show over-reliance on a high win ratio, tight profit taking, and slack stop losses. This is typically not good and shows under decorrelation. The second extreme is the opposite. I call it the sniper type. Steady equity decay broken by large bouts of profit taking. This here shows a very low win ratio, large profit taking, and tight stop losses. So unless the market absolutely warrants it, then it might show another kind of algorithmic diversification imbalance. A solid and diversified portfolio, however, should yield a straight, smooth equity curve without major locksteps. In other words, it should not be subject to any of these two biases. Its win ratio should be close to the 45 to 55% range, and its average reward to risk ratio should be somewhere between 1-for-1 to 2-for-1. One way to get a good quantitative hint of that systematic behavior from an equity curve is by finding a very high R-squared statistic, with very high being defined as 99.5% and up. So here we are. Now think of the fact that you likely started this course with no other point of reference than your cookie cutter reward to risk ratio to determine your entries and exits. I hope you can tell by now how much more there is to it, and how much more work goes into them. What I want you to remember from this course is that solving for entries and exits will take care of itself if you sufficiently focus on the concepts of expectancy and decorrelation that we reviewed together in series 1 and 2. No other blanket considerations should distract you from it. If you understand your market and its price formation, then coming up with an algorithmic blend that both maximizes your risk-adjusted return and mixes your entries and exits in a healthy fashion should not be difficult. Proceeding step by step and understanding that entry timing is not a building block of your system design, but rather a derivative of it, is a major piece of knowledge that should already put you way past the majority of traders and give you the upper hand in building superior trading systems. So use that knowledge unsparingly. I'll talk to you in the next one.